Hi everyone. Okay, let's continue on. So here we had talked about if you have accounts receivable from a customer and then the customer pays you cash, we need to reduce the accounts receivable by crediting it because it's an asset. So in order to reduce an asset, we need to credit it. And the reason we credit it is because they don't owe us that money anymore because they gave us the cash, and the cash of 1900 is debited because they gave us cash, so our amount of cash has gone up. But then also on March 27th, we paid a supplier. Okay, so because accounts payable, so we owed the supplier. Okay, so it was sitting as a liability in our liability account, or our liabilities accounts payable account, sorry. So the normal direction of a liability is a credit. So in order to reduce that accounts payable, we need to debit it. And the other side of the entry, because it has to balance, is cash, because we're giving our supplier $900. So our asset called cash is now going down. And the description that we're putting there is cash payment to supplier. Okay. So on March 28th, Haley, the owner of the company, decided to take a withdrawal from the company. And if you remember, the reason she's doing a withdrawal is because, well, one, it's her company, and two, if she wants to get cash out of her company, that's how she has to do it. She's not allowed legally to list herself as wage expense or salary expense. So the way to get money out of the company to pay for your own personal expenses or whatever it is, because you can't mix your personal with the company, she has to take it out as a withdrawal. Okay? And a withdrawal is a debit because it's reducing your owner's equity. And again, it's one of those that people struggle with. Okay, withdrawal, is it a debit or a credit? Look at the other side. She's taking cash. Cash is being reduced. We know cash is an asset. So when cash is being reduced, we know we need to credit it. So if we're sure cash is a credit, then withdrawal has to be a debit. And then we can justify that withdrawals are the debit by saying that we know it reduces the equity. And if you think of equity on a balance sheet, equity is on the credit side of the balance sheet. So we know in order to decrease our equity, it needs to be debited. Okay, so on March 29th, collection of payment for future services. So again, this is something in the future. And if you remember, we went through some accounts that look like this. Okay, so unearned food service revenue. So it has the word revenue in it, okay, but it's not a revenue account because it's unearned. Okay, so it's the same as a deposit. So we're going to list it as a liability. They're giving us cash, so we know our asset called cash is going up by $3,000. But we haven't done anything to earn this revenue yet, so it's a liability. We're liable to either provide them with the service or give them their cash back. So that's why it's listed as a liability. And then the final recording for this month is the payment of insurance coverage. Okay, so we're paying it in advance. We haven't used this insurance yet. We're paying it maybe for the next year, for the next 6 months. So we're going to record it as an asset called prepaid insurance of $2,400. Okay, so that's an asset. There's value in it. We get to use that or have that insurance for the next year. And then the way we get that insurance is by giving the insurance company cash. So our cash account is being reduced by $2,400. Okay. So the ledgers, okay? Ledgers contain financial statement activity for each specific account. So of all those entries that we made, we now need to post those entries into each of the ledger accounts. And again, each account, cash, prepaid insurance, withdrawals, capital, all of the expenses, they all have their own ledger account, or what we had called last chapter, or last lesson, a T account. A T account and a ledger is the same thing. There's just more information in the ledger. It has the date, it has an explanation of what's going on, the account numbers. So a general ledger summarizes each financial statement account. So we know cash, we know building is on our balance sheet. We know that all of the expenses are on our income statement, our revenues on our income statement. Well, maybe we want to know, where did $10,000 revenue come from? We can go to the ledger and look at all the detail of every single transaction that happened in the revenue account to bring us up to the balance of $10,000. Okay, and again, that's just a random number I picked out of the air. So an abnormal balance. Unusual transactions can sometimes give an abnormal balance to an account. Okay, so for example, a customer might mistakenly overpay a bill. This will give the customer's accounts receivable an abnormal credit balance. Okay, so if they paid too much. Be alert for abnormal balances, as they may be as a result of an error in recording a journal entry. Okay, and once we get to the trial balance, I will show you that sometimes an abnormal balance, which would help you see that you've made an error, an abnormal balance can be a good key to knowing that you made a mistake. And we'll talk about that in the future when we get to the trial balance. Okay, so preparing a trial balance. Okay, so again, preparing a trial balance. So we recorded every transaction in the general journal. Then once we recorded it in the general journal, we posted all of those journal entries that are in the general journal into the appropriate ledger account. So anything that affected cash, we posted to cash. Anything that affected each and every individual expense was posted in each individual expense account. And then after we posted them in, then we have to add them up and come up with the balance in each of the ledger accounts. Then once we've got the balance in each of the ledger accounts, then we can create the trial balance. And the trial balance, the way we create it is by using our chart of accounts. So we use that numbering system to put all of the numbers for all of the accounts in orders. So if we've got 101, 102, then our next account might be 201, 205. Then our next account might be the equity accounts, which is the capital account or the investment account and the withdrawal account. Then we have our revenues, then we have our expenses. And it always, 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 always goes in order of your chart of accounts, okay, or that numbering system. You can see that here. Okay, so the trial balance for Organico, we've got cash, then we've got accounts receivable, supply, so you can see all of the asset accounts come first. Then we have the liabilities. Then we have the capital account. Then we have the withdrawal. Then we have the food service, the revenue accounts, the teaching revenue, and then the expenses. and then we add up all of our debits, we add up all of our credits, and it has to balance. If it doesn't balance, there's an error somewhere. Quite often, if you go back and look at your journal entries, maybe you forgot to post something into the general ledger. Maybe you transposed or mixed up the numbers in the balance when you transferred it from the ending balance in the general ledger to bring it over to the trial balance. Okay. Also, where I mentioned earlier something about an abnormal balance, well, if you looked at the trial balance and you looked at, say, all of the liabilities, and all of a sudden you looked and you saw, well, why is my notes payable have a debit account or a debit balance? That doesn't make sense because all my payables or all of my liabilities have a normal credit balance. Did I make a mistake? Or what if your rent expense, instead of showing $1,000 as a debit, is sitting over on the credit side? Oops, I must have made a mistake because it's not showing the normal balance. Let's go back and look at the entry. Okay, so keep an eye for that pattern, and that's one good thing about everything being listed in order by chart of accounts or your account numbers. Your assets come first, so they should all look the same. There shouldn't be an asset that has a credit balance, right? So get used to watching that pattern and knowing what is the normal balance for your assets, what's the normal balance for your liabilities or your capital or your withdrawal or your revenue or your expenses. Okay. So this is just giving you an overview of exactly what I just said on how to make sure that your trial balance looks correct and how to pick up some errors. So feel free to stop the video and read this very clearly, very closely, so that you can pick up any errors that you might be making. Okay. And then this is a summary. If you want to go through a summary of the chapter, feel free to go through these PowerPoints, and I have the PowerPoints on the in the Brightspace page as well. Thanks everyone, and again, always remember, if you have any questions, give me a shout, and I'm more than happy to help. Thanks everyone.